Grinnell Capital is a boutique asset management firm based in Park City, Utah.
Good morning. My name is Frank Grinnell. I've been investing in the stock market for over 20 years. It serves as my day job, and most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we share high-conviction ideas with subscribers, and we actively manage stock and ETF models for financial professionals and their clients, as well as individual investors. For more information, check out our website. Before we get to today's podcast, be sure to hit subscribe. And now, today's Street Views.
Hey, good morning. It is Thursday, one day post Fed announcement. Things are looking a little different out there. We'll get to that in a second. I want to talk real quick about, go to the micro and then go to the macro. And by the micro, I mean specific stocks. So Eli Lilly gave an investment presentation. I think it was an investor presentation yesterday. And Morgan Stanley had some interesting comments on the note that last night for today that I wanted to share. Calling Eli Lilly the most robust new product cycle outlook in pharma. 5 new drugs over the next 2 years, targeting things like Alzheimer's, cancer, immunology. Two of those drugs are expected to produce sales over $5 billion by 2030. This will boost top line by 40% in 2025 versus 2022, and will help achieve earnings of $15.62 in 25 and $26.43 in 2030. So they're going, I don't know how you got to 2030, but they're trying to do it. Current EPS estimate for 2022 is $7.79. So 2025 of $15.62 is roughly 2x the $7.79 estimated for 2022. It seems like stock's not cheap. I mean, the pipeline is well known to be really robust. I wouldn't be surprised actually to see the stock sell off a little bit just because it trades at 40 times forward. And the news is out as far as, it's good news. It's good guidance. I mean, 40% top line is great. Boosting top line by 40% for 25, excuse me. So, but make no mistake, I think this is a must own. You may want to buy it on dips. We'll see what happens here. Week tape too, so you never know. So that's that. Another, staying with healthcare, Moderna. So you guys saw they had a readout. It was a phase 2, if I'm not mistaken, of a melanoma vaccine in conjunction with Merck's Cure Data or Cure something. Positive readout there. And well, everyone's known that they've got a bunch of shots on goal, Moderna. They've never seen a real readout. So this is, stock obviously had a really big move 2 days in a row. I expect it now to probably mark some time and hang out. But something to take a look at. I mean, this thing trades, it's always been cheap because people don't give a lot of credit for the COVID revenues and earnings going forward. But nevertheless, as they start to fill in this pipeline and the visibility gets more clear and they get more validation of the technology working in other diseases, I think this stock can do really well. So something to keep an eye on. 7 times earnings. Again, not a lot of credence for that earnings component because of the COVID, but something to keep an eye on. We bought a little bit, and we're gonna keep an eye on it at this point and see how it does. We own Lilly as well. And then on the macro, really, we're becoming relative hawks out there. You look at Canada, Australia, they're probably done raising rates just because the housing market there is a lot more levered and they've got variable interest rates, variable mortgages for a lot of their home buyers. Same with I think the UK as well. UK had 2 of 6 vote for unchanged. So in response to that, we saw the usual type stuff happen over here. We got the dollar looking up 57 bips. S&P looking down, what is that, 130 pre-market. Again, here we are. We're gonna fail again at this resistance line. It's just just ironic, right? So we're going down again. We'll see what happens. It's I don't know. We'll see. The one thing that's interesting, our bonds our interest rates are going down. So you look at the TLT, that is actually getting better and better throughout the morning, got better and better throughout the day yesterday, post-Fed, getting better and better now. So maybe we've actually, in earnest, crossed over that threshold where we're worried about rates. So now it's the economy, stupid. And the bond market's trying to tell you the economy is weakening big time. You've kind of, the message from the bond market to the Fed is you're not getting to 5% Fed funds. That's the message right now. So who's right? It's going to be the Fed's going to be right, or the market's going to be right? I don't know. My bet is the market. It's trying to discount some serious weakness coming up in the economy going into 23. And this is more evidence of that, right? You've got the 30, the TLT is up 50 bips here this morning, and the 10-year is up as well. Obviously not as much, but that's the lesson, kids. Economic weakness might be on the come, as we're all worried about, but maybe it's a little bit worse than everybody thinks. Who knows? That is all. Enjoy your Thursday. Back to you tomorrow.
And now for some important disclaimers. This podcast is intended for financial professionals only. Grinnell Capital LLC is a state-registered investment advisor located in Utah. Services offered by Grinnell Capital can only be offered in the states of Utah, Idaho, California, and Texas, where Grinnell Capital is registered or where otherwise legally permitted. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisor.info.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be consumed, construed at the provision of personalized advice, and is subject to change without notice. This material should not be considered a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital LLC as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility. Therefore, this podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve long relative and risk-adjusted returns, primarily by investing and trading securities issued by companies that focus on the global information technology, consumer healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth potential and an abundance of both new and maturing product cycles, a field of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange traded fund, ETF strategy, with an investment objective similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some risk aversion in the event of significant market stress through investments and ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital LLC has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, www.grinnellcapital.com.